Good afternoon. My name is Jennifer DeMudd, and I am the Executive Director of the Manufacturing Growth Alliance, also known as MGA. We are a membership-based organization that provides services to help manufacturers build smart, lead strong, and establish a pathway for future growth. Our services drive solutions that make manufacturing in Michigan the most competitive and prosperous in the nation. The decision to transition a business needs a lot of thoughtful consideration. Whether you're tossing around the idea or you've made the decision, planning is a critical element to the success. We are fortunate to have a very good partner of MGAs with us today to talk about succession planning. But before we begin, before I introduce our facilitator, I'd like to make 2 points. One, we are recording the conversation. All of the panelists are not, we will not be able to see, all of the participants will not be shown in the recording, just the panelists. So know that we are recording for future use. And then also know that if you have questions as we have dialogue with our panelists, please feel free to include those questions in the chat feature of the system. So our facilitator is Mike Powell. Mike is a principal at Raymond, and he is a manufacturing practice leader. Mike provides tax consulting studies focused on identifying opportunities to help clients reduce their tax burden. He is a firm-wide authority for research and development on tax credit studies, domestic production activity deductions, accounting methods and periods, and exposure items and inventory analysis. Mike leads Raymond's manufacturing group, serving hundreds of clients in the industry. Mike, thank you for facilitating the conversation today, and I'm going to hand it over to you.
Well, thank you so much, Jen, for letting us. This is a very important topic, and we're seeing it a lot with a lot of our clients right now. So again, it's very important with our manufacturing clients and manufacturers throughout the state. So again, thank you for letting us bring this talent and this expertise to our manufacturers. Let me introduce the panelists first, and then I'll kind of lead into with Eric Shoemaker. So Eric is a principal in our advisory and tax service. He is in our Grand Rapids office. Ryan Sullivan is a principal in our Raymond Wealth firm here associated with Raymond, and he is located in the Traverse City office. Elizabeth Williams, she is a principal in our HR Solutions department, and she is located in the Troy office. And then Mike McCarthy, who is a principal in our advisory and tax services, located in our Ann Arbor office, and I am located in the Troy office. So again, thank you for letting us present on this important topic. So what we're seeing a lot in the industry right now is we have manufacturers, those family-held businesses or closely held businesses that kind of went through the recession back in 2009, 10, 11, and then all of a sudden a pandemic hits. And so it's maybe it's time for us to get out, or maybe sell, or maybe look at second generation or third generation from our manufacturing standpoint. So what we usually is when you sit there and speak with your clients or manufacturing, like, I think I'm going to want to sell in 6 months. Well, it really is not that easy. So there's a lot of forward thinking that must take place before you want to even think about selling, and then going through that whole process. It should be a several year process. So as soon as you get the mindset in, that's when you start bringing in the specialists. So I'm going to hand it off to Eric Shoemaker. So maybe we're thinking about selling our business, our manufacturing company. Eric, what are some of the things that they should be thinking about, or manufacturers should be thinking about once they kind of have the mindset is, I'm thinking about transitioning and retiring at that point?
Yeah, thanks, Mike, for handing it off here. And I think everybody will notice a common theme from all the panelists about it's never too early to start thinking about this. And the longer you have to prepare, or the more runway you give yourself, the more flexibility you have in that strategy and things that you can do to either increase value or create wealth transfer activities that will benefit you in the next generations to come. So kind of the first thing, right? If we've kind of starting to think about this idea of transition, whether that be internal management, family, or an external sale, is the first question we got to answer is, what do we think the business is worth? And that can mean two different things, really, right? What is it worth in an external transaction? But then, as my colleague Mike McCarthy is going to get into a little bit later, what is maybe the tax transfer value, and why are they different, and why do you want to know what both are? And we encourage our clients, once we start to think about that, to start having some preliminary discussions with our valuation team to really understand what those value numbers are, and then put those on the table and help them clearly understand what that means to the family currently and then the family in the future. And one of the big questions that comes up in that initial kind of discussion is, are you working in your business or on your business? Are you making decisions that are creating more value as you continue to drive into the future, or are you just really bogged down in the day-to-day aspects of the business and need to step back and take a bigger look at the overall valuation perspective? And we see our clients get to the point of starting to entertain a transition in a couple different ways, right? As Mike alluded, there's been some pretty significant economic and social aspects that have come into owners' vision here over the last decade or two. And the other side of it is the market from an external exit is pretty lucrative right now. Multiples are extremely high. Even with, Fed rates going up, money is still pretty cheap. So valuations are very high on the external transition. And I think we find most clients, when they start to talk about this process, start to entertain what an external sale might be, are very surprised to understand what they think the enterprise value is currently internally without doing that due diligence, and then what they find out. At this moment, it seems to be quite a surprise to most of our clients of what their businesses are really worth in an external type transaction. And so, the patriarchs of these businesses, our clients that are thinking about this, are really looking at, hey, I've put a lot of blood, sweat, tears, equity into this business. I've generated some value, and I'm at a decision point. Do I want to continue to be responsible for that going into the future? Do I have that next generation in the family who is? Or, all things being equal, is this a great time to maybe capitalize and take this illiquid asset and turn it into some type of liquid asset for me, my family, and the generations to come? And so not all stories are the same, but the decisions clients have to make along the way can be, and we're there to help them with that process. But again, I go back to the reoccurring theme you're going to hear here. It's never too early to start thinking about it. And if you haven't started to think about it, you probably are behind the eight ball in today's current environment, just where we see the merger acquisition practice in the middle market companies in the Midwest here. But, a big piece of that is, one, understanding what the business is worth, and then understanding what that means to you, your family, to the generations that maybe you're trying to provide for. And that's a perfect segue for me to hand it over to my colleague, Ryan Sullivan, who will talk a little bit more on those aspects of understanding that personal financial planning aspect of this.
Thanks, Eric. For me, the key takeaway there is planning and timing, right? Take advantage of time and be proactive. Think ahead, think about what's important to you. Over the last 2 years, we've seen a pretty dramatic shift in the volume of deals and potential buyers for many different businesses in the marketplace. A lot of that's due to, as Eric had mentioned, cheap money. But there's also a lot of cash on the sidelines just due to an expensive stock market, low interest bonds, and cash paying close to nothing. And so there's this market for buying businesses. And it reminds me of, a dear friend of mine. He buys and sells classic cars. And I remember years ago, he told me, no matter what the car is worth, if I show up with a bag of cash, it's hard for that car owner to turn it down, even if it's way below the market rate. If there's a stack of cash sitting there, it's hard to turn it down. And I found that interesting, because if you're the buyer, that's great. But if you're the seller, that puts you in a tough position to manage those emotions and maybe short-term financial needs to grab that cash and then get rid of this asset. So something that for us, we can consistently see is for those folks who plan ahead, have a working knowledge of what their business is worth, and then have thought through different deal structures, they tend to have significant leverage to maximize the opportunity. For most business owners, this is a once in a lifetime opportunity to maximize your life's work, or potentially multiple generations. I mean, we see so many multiple generation family owned businesses that this is the generation where it's going to leave the family. I mean, this is significant stuff here, not just the economic side. So being proactive and planning is significant. And so how do you do that? Right? What we have found, if you want to be proactive, so when the deal shows up, start today, start yesterday, start as soon as you can. It's really thinking ahead about what's important to you. What are the goals for you, your family? Who are the other stakeholders in the business? So if you have other family members, if you have key executives, key employees, which we'll touch on in a moment, what's important to them, or what do you want to leave them? Especially if you're looking at an outside sale. And so as you start to think about what's important in putting on paper what those goals are, then you start getting into some more of the specifics. So you start looking at why now? Why is now the right time? I know for the last few years, as we, from COVID to today, we've seen many business owners who maybe were looking at 10 years before they wanted to have this liquidity event and transition out. And they've all of a sudden said, look, I'm ready to be done. I'm ready to be done. This has been exhausting. And so all of a sudden you find yourself in a position where maybe you didn't plan on this exact timeline, but deals are coming your way. And all of a sudden you're in a position to have to figure out how to do a deal, but then also how to, accelerate your personal planning and thinking of all the potential stakeholders and who's going to be impacted by a transaction. So think about why now? Why them? If it's an internal family transition, if it's to management, if it's to employees, if it's to a financial buyer, if it's a strategic buyer, why them? Why are they the right fit for you to partner with to do this deal? And then as you dig in, start thinking in terms of the next layer down. So you've established what's important to you, what's important to the stakeholders, why, what is the ideal partner as far as where you want to transition the business to, and then start thinking about you personally. How does this impact your balance sheet, right? Assets, liabilities. This is going to be a pretty dramatic shift for most business owners. The business is one of the largest assets they have in their net worth. So you're going to take this, as Eric had mentioned, a liquid asset from the traditional sense and transition it into a completely different type of investable asset. How are you going to manage that? How is it going to impact your balance sheet today? How is it going to impact your balance sheet for the next generation? And start thinking ahead. Additionally, and this is one that we see often, you have inevitably, you work so hard, you're in the mix on a deal, you get to the end, you close, and then you lift your hat up and say, well, wait a second, where's my paycheck going to come from tomorrow? I've been getting a paycheck steady for 40, 50 years. I know how to make money in my family's business. Where am I going to get money from to live? And so these are the important things to start thinking ahead about. So cash flow, what do you need from a cash flow standpoint? Incorporate that into the right structure of a deal. Do you want to be out of the business entirely? Do you want to stay in the business and generate some income? What are the household expenses? Income and expenses are two different things. So what are the expenses you need to cover? And what is that lifestyle that aligns with your goals? Mike McCarthy, coming up here shortly, is going to discuss estate planning, but that's another critical piece. Think ahead, think of the next generation and beyond. How does this transaction align with you accomplishing your estate planning and legacy goals? Charitable planning, thinking about this well before you have a deal in front of you, can allow for some really creative, efficient tax planning strategies by leveraging your charitable intentions and thinking about this asset, this transaction as an opportunity to both take care of charities that are important to you and your family, while also maximizing the value of the business. Family dynamics. This is another one that the sooner you can really feel and understand the dynamics of a potential transaction related to the ripple effect with your family, the sooner you can have that conversation and start planning around that, typically the better and the more flexible you are. So as we get through that, thinking about the shareholders, the owners, the other key piece, before I transition this off, the other key piece is how does this impact the key employees of the business? And that's something where if you don't engage or start thinking of that group early enough, all of a sudden you might find the business in a precarious position if you haven't considered what's best for them. So with that said, I'd like to transition it to my colleague Elizabeth, and she's going to take it from there.
Thank you, Ryan. And I want to pick up where you left off, talking about a company's people. These are your employees, from the key employees that Ryan mentioned to all the other employees. What I'd like to talk about is, in regard to your employees, firstly, who are you going to consider selling the company to? If that's one of your key concerns of continuing the livelihoods of your employees, supporting their families, the culture that you've built for your company, who is going to shepherd that to the next generation or outside of the company? So that's something to keep in mind. It was just in the news that Shepler's Ferry in off of Mackinac Island, they sold their family business to a billionaire who was in a similar ferry business in another state. And they chose him very carefully because of the well-being of their employees. And indeed, some of the family members were going to stay on and continue in the business. I'd also like to talk about identifying gaps and blind spots before you decide to sell, before the due diligence begins. So that way you can have the strongest standing for yourself. These are things like, are you compliant? In my HR world, a lot of it revolves around people and compliance and making sure that we're, working within those goalposts there. Are your health insurance benefits compliant? Depending on the size of your company, there's different rules and regulations around that. Do you have the proper risk insurance in place? What is your 401k plan looking like? And in the sense of there could be things in there that you aren't aware of that could trip you up in a sale. Any of those things can. So you want to start digging out those documents and having your brokers take a closer look at them so you don't get shown where your gaps are. You know them up front, and it's okay if you do have them. When you enter into a sale of your company and the due diligence process begins, you're going to be asked questions about your people. You're going to be asked about employee issues, particularly any past legal issues, and of course, any current ones, and historical data on pay, your risk insurance claims, 5 years back of workers' comp claims. These are the types of things that the records should be maintained, but where are they? These are the things that you'll want to start putting your arms around and getting situated so you don't have to scramble when it counts the most. When you enter into that due diligence phase, there's so much data that is requested. Be as prepared as you can with those things. And the easiest way to do that is to go to your brokers for those things. They're going to ask you about your auto coverage. If you have fleet, what are any claims on that? They're going to ask about litigation, as I mentioned. So if there's any skeletons in the past, even if you don't consider them skeletons, they're going to be looking for them as they go forward to purchase. And it's not all bad, right? It's just wanting to know the playing field. So if you do have some gaps or non-compliance, I'll go into that in a little bit further later on, but it's not the end of the world. You don't have to fix everything. Sometimes the sellers will come in and partner with you and help fix those things. So it's not a deal breaker necessarily. What about you as the owner? Are you looking to stay on? Are you looking to exit? You can structure that into the deal. How long do you want to continue to work? You can specify the amount, how long, what you want your level of benefits to be, however you would like to carve it out. I've written several employee agreements as part of the deal, and also transitioning out of it. How do you want to transition out so you're prepared, and the company that you stayed on with, that new owner doesn't transition you out on their terms and not yours. Proactivity is key. I've written contract agreements for the former owners a year or so after they have sold their company, and they've decided I'm ready to leave, but I kind of want to stay on and, maybe help a little bit part-time as an independent contractor, or the company would like you to stay on because of that knowledge that you have. They really don't want to lose you yet. So that might be to your advantage to structure the deal in such a way that's the most advantageous to you. When you do that up front, you've got more leverage. When you do that after the sale, they have more leverage. So think about that. I also counsel business owners, and they don't necessarily like to hear this, but you want to set up your own LLC for your own person in order to continue on as an independent contractor. If at that point, after the sale, you stay on with the company, that might be the best way for you to go, or, change your structure to part-time as you're kind of unwinding yourself and totally backing out of the business. Those are some things to keep in mind. It's extra paperwork and extra headache. I know I've worked with business owners and helped them through that, but it just is a safer way to protect you. And it also protects the new owner. And start thinking about how you want to communicate this. If you're going to go to sell, who's affected? Your key stakeholders, maybe other family members, and your employees at large. So you want to start thinking about who you're going to start talking to in your circle of trust, if it's family members or other key people, and at the right time. And I'm a big proponent of company culture. I've been on both sides of the M&A process. My last role prior to Raymond was doing the HR due diligence on a team like this for my company who is acquiring assets, acquiring these companies. So one of the things that I always took the approach of as the buyer was, what is the culture of the people? They make the company. I don't want to break a company culture as I'm bringing them into a new family setting, especially if it's part of a new corporation structure where all of a sudden now you go from one company to maybe they're one of 6, right? It's a different setup. So those are things to consider, leading with your culture and making sure that you find the seller, the buyer for your company that's the best fit. So culture is key. I would think that as a business owner that you started your business, you want to see it continue to thrive and grow and provide for future generations. And being very mindful of that culture fit, and especially with a new owner, will secure that for that future. And then I'll turn it over to Eric.
Thanks. Yeah, thanks, Elizabeth. So as you mentioned, plus with Ryan and Eric, this is not one day we're going to sell and we're going to sell the next day. This is a very forward-thinking process, right? And so it's always good to kind of have those ducks in a row before you even determine that you're going to sell your business or transition your business. But let's say we're in the mindset now. We're going to transition our business, or even on the other side, we're going to purchase a business. There are so many planning and due diligence aspects to either selling or buying your business. And so Eric Shoemaker and Mike McCarthy are going to kind of go through some of that due diligence that needs to be done, and also some of the tax implications that are associated with either selling or purchasing a business. So I'll turn it over to my colleague, Eric.
Yeah, no, appreciate it again, Mike. Yeah, so as Mike mentioned, as we start to move into that actual transition or transaction, due diligence is a buzzword or that phrase that you'll hear a lot of, and it's becoming more and more prevalent as a preemptive type activity that sellers are doing before they go to market. So I spend a lot of my time in our M&A practice, as does Mike and a number of team members here, but sell side due diligence is becoming commonplace in transactions in the middle market. Traditionally, rewind a decade ago, that was really meant or invested in large transactions, but you're seeing that as a readiness and preparing for going to market for a couple of reasons, right? For you to get a clear understanding of what adjustments a buyer might make when they're looking at your earnings, but also to help build that picture and be able to go to market, either addressing some of the things that might come out of that or being able to address them right up front and not have them be adjustments to purchase price or renegotiation pieces later in the transaction. So very commonplace. And then on the buy side, right, if we're a company who's looking to grow through acquisitions, making sure that we do our proper due diligence on that target and make sure that we understand what's there, what they have, are the earnings that they have reliable, or are there adjustments that need to be made? A common practice, which is referred to as quality of earnings reports or strength of earnings, is really having a third party go in and look at their earnings, their EBITDA, and look at what's normalized, right? Do we have an owner who's taking a significant wage or not taking a large enough wage? Do we have to adjust that for the way that it's going to operate underneath our structure? Are there potentially personal items that are running through the business or that we won't be incurring after the owner is no longer with the business? All of those things are due diligence items and preemptive things that if we're going into the market to sell or transition, want to make sure we're thinking about up front, again, so we can head off any future surprises or negotiation points as we do that. And then another big thing, whether we're transitioning to the next level, and it gets back to maybe a little bit of what Ryan mentioned earlier, just right, understanding cash flow. Well, in my world and Mike's world, that's after-tax cash flow, right? Understanding what the taxability of a transaction structure or transfer is, and understanding what we are left with at the end of it. We have a lot of clients that go into the M&A space, right? And they'll get that first letter of intent that'll have a enterprise value on it. Well, that's not what we're putting in the bank when this thing ends, and that's where we spend a lot of our time, is helping make sure our clients understand what that is and doing that sooner than later. So if there's things that we can tweak in the transaction or tweak in the transition, we can take advantage of that, and we have the time to do so. And some of those things we need some time from a tax standpoint to be able to implement, so they're not so close to the actual transaction itself, for being able to hold up that the positions are done separate of each other. And, Mike, I'll let you get into it, but as we're thinking about even an internal transition or a sale, estate planning has to be at the forefront of how do we transfer, whether that be part of the transaction or just part of an internal transfer, and be efficient in that standpoint.
Well, I want to just comment on something. Even if you're not sure you're going to go to market with your company, going through the process of evaluation, a due diligence, strength of earnings, will give you a different perspective on your company regardless. And it's worth a lot. You'll see what the value drivers are. You'll see what someone on the outside is looking at. It may not be what you're focusing on in day-to-day operations in providing net income. There may be something that they're looking for that would really drive the outside value of the company to someone buying it. And I just mentioned that there's real value for just going through the process. And Eric is obviously right. The sooner you start this, the better. And there's all kinds of issues with respect to the sooner you start, the more you're going to recognize if there's roadblocks or there's things you weren't aware of with respect to the tax ramifications of doing things. The other thing is, if you know you're going to do this, there may be some planning you can do way down the road where you're perhaps fracturing your ownership, gifting it to children or trusts, where you still maintain control, but you're getting some of the growth out of your estate. You may also getting some income tax benefit by spreading the gain around. So those are things that if you do them early, it's great. The tension is that you are giving up assets, even though if we can structure it where you're maintaining control. So there's a tension there. I'll get into later the difference between having a family succeed in the business and going to the outside. They're very different strategies when you have that situation.
And one thing I think we got to chat about just a little bit is the importance of buy-sell agreements in this kind of planning as well, right? Understanding, one, do we have one? Two, how long ago did we put it in place and what's changed? Because those are very, powerful tools in planning and making sure if something happens while we're in this process, prior to it, after it, that our intentions are that we're not left with the company in limbo as to, one, how do we fund that? How do we do this? And where does it go? So I just recently had a client, a new CFO involved in a very profitable and very valuable business here in the West Michigan market, come into the organization, and his first question to the owner was, "Hey, I really want to understand this buy sell because I know we've got a lot of value here, and I want to understand what kind of stress that might put on the business." And the owner's comment back was, "What's a buy sell?" And that's a perfect example of, I think this is something that's not necessarily focused on, or hey, we kind of checked the box when we did some corporate documents initially when we set up the business or the partnership, but they need to be revisited, right? Family dynamics change, values change, and funding those values is a big question sometimes, right? If we have a prescribed agreement that kind of talks about a forced transition, which is really where buy sells come into place more often than not, how do we fund that? What kind of stress does it put on the business? Is it going to force us to go to market when we otherwise don't want to because we have a value that we have to generate, and it doesn't give us that flexibility? So it's just something that kind of comes to mind whenever we're talking about this transition topic, that it's a very important document that's often overlooked and should be considered, now versus later at any moment in time. It should be revisited. Kind of think about it as a will or other estate documents. They're not meant to be done once and filed away and never dealt with again, but to be revisited on a regular basis. So I bring that up. But, as we are talking about the tax considerations and all the other things that go along with a, transaction or transition, it's a perfect time maybe to look back at Elizabeth and start talking about, again, some of the internal more human resource ramifications or items as we're continuing to move down this path into a actual transaction and what we can do through that period.
Yes, thank you, Eric. So once you've had your mind made up that you're going to go to market and sell, let's circle back to your people, specifically your people data. You're going to be uploading or sharing a ton of content to typically what's called a data room. Very secure, cloud-based, where you shuffle all the documents and you're going to have a lot of checklists to go through. Some things you won't be able to supply because it doesn't pertain to you, but much of it will. So when you're preparing your data, make sure it's as clean and easy and usable as possible. Meaning that PDF is not as easy and flexible as an Excel spreadsheet, right? And the reason is that once they get that data, they're going to be flipping it around and analyzing it, cutting it in different pieces. And the last thing they need to do is waste time with handwritten notes or, scanned documents and PDFs of actual data. Finance is the same, right? So make sure that your payroll reports are shored up, that you're giving the most current information. I've seen it where payroll data was provided and kind of spotty. It didn't include everyone. You want a very clean census. It's called an employee census. Sometimes the names are stripped, which is fine. In the beginning, that's fine. But they'll want to know a lot, their pay, how long they've been there. So you want to have the hire date, what their rate of pay is. Are they salaried or hourly? Because they're going to audit to see if you properly classified your employees pertaining to their job duties rather than just, making everyone salary or hourly arbitrarily. That's very important because that's a non-compliance issue that they would then be inheriting, not just for now and the future, but the past. The sins of the past that an owner may not be aware of carry forward to the new owner, and that's what they're looking for. You'll want to have, I would give a full census, at least the city that they live in, state, obviously, the hire date, the last change of rate of pay. That's key as well. And I'll give you one example. It wasn't the one part of that fell apart in a deal that broke the deal, but it certainly did not contribute nicely to the overall trust and well-being of the deal, where an owner gave a bunch of payroll data early on, looked good, The deal was still going through due diligence, and then all of a sudden, new reports we've got our hands on where significant pay increases were given, particularly to key employees, particularly to the owner himself, that was done under the radar and popped up later. And that one item didn't blow the deal, but it definitely had an air of distrust. What else are you trying to slip in before the close of the business? And ultimately, it started to water down the value of that deal. Not just that, but for other financials, that when it came clear that things were just not adding up to the story that was being told, that the seller actually ended up pulling out of it. I think they realized that they weren't going to get the top dollar that they thought they could have, but the way they were going through the due diligence process created so many obstacles and hindrances, they couldn't get it past the finish line, and it kept diluting that number. So honest data, integrity, all those things to be on the up and up, because eventually it will come out. As I said, those skeletons, they do come out. Who are your key employees that you identify, the ones that really are the heartbeat of the business, that if they stop coming to work tomorrow, it would cripple you? There's that tribal knowledge in a company that you can't just necessarily pluck off the street and replace. And it could be, as I said, a family member. I had another deal that I was working on where it was 3 owners, and one of them had a son that was integral, had been working there for like over 20 years, and he wasn't even 40 yet. He wanted to stay on with the business, wasn't necessarily going to be the new owner, but he wanted to stay on. And there was concern on both sides where we wanted to keep him, make sure we didn't lose him, because he was the linchpin, literally, who knew so much about the ins and outs of that business. But he also wanted assurance that they weren't going to part ways with him after downloading his information from his mind and then a couple of years later letting him go. So, and that was a deal where we structured an employee agreement for him specifically for a longer term than we normally would, to give him the good faith that we want you to stay around. And in fact, we want to invest in you. Even though he grew up in the business, he didn't necessarily have that management leadership, but he had the potential. So not only did they structure it to say, we're going to give you a 4-year employee agreement to lock you in, to give you that confidence that we're confident in you and don't want you to go. We're going to pay for your schooling, for you to go and get your degree that you didn't get because you were right there from after high school working for your dad. So it's that type of thing that, as an owner, if you have family members in that type of situation, you can work that into the deal. Most definitely. And then as for the other owners, it was 3 owners, as I said, they were all in different phases. One wanted out completely, and the other 2 wanted to hang on for a couple of years. So it was structured in such a way. And now that deal, the due diligence was spotty in the sense that their payroll data and employee data and their financials were not readily available. Every month we'd ask for another forecasting report, and they just didn't have the wherewithal to be able to have a tidy accounting. They just didn't. It didn't break the deal. What it did was it allowed the buyer to go in and say, let's just handhold you a little bit. We'll help you through it. We know what we're looking for. Give us the raw data and we'll put it together and help you along. And also, they didn't know their health insurance plans that well, or their level of risk insurance. Was it enough? Was it too much? Are they paying too much? So with their permission, they said to me on the buyer side, well, talk to our brokers. So in that case, it can be incredibly stressful, the amount of data that they're asking you to put together. And if you don't have those things tidy, where you can pull your workers' comp policy, you can pull your benefits and all your rates and all the history, you can grant access for your brokers to talk to a key person on the buyer side. In this instance, it was me. I was talking to the brokers, getting the information that I needed, but also understanding that I had to get that permission from the seller first, because obviously, why are you talking to me? They're selling their company. So you have to have that conversation with your brokers that this is a confidential, or if it's well known. So then I would get the information I need. And then from there, it was easy for me to identify the gaps. And there's typically gaps, but it's not, again, a deal breaker. Then we know how to structure the deal toward the end of the sale. Do you need directors and officers insurance? You didn't have it. You should have, right? In some cases, there are things that you should have had that you didn't know. Your broker either didn't inform you of that, or in this particular case, the broker said they really are underinsured, but that's what they wanted. So they didn't have enough insurance. As soon as you are under the umbrella of the new company, your company and your employees are under that umbrella. However, for the gap, you may have to get a D&O tail. Or if they discover that there's some either legal past history that is either real, like it was an actual lawsuit, or the potential that there were some things, a skeleton in the closet, for instance, they're going to ask you, do you have any disgruntled employees that have left in the past 5 years that could potentially come back and sue you? So be honest and truthful with that history. And again, they may say, we want you to take out a reps and warranty policy. And that just makes it smoother for both sides. So that way, no one is gone after directly. You've got the insurance company in the middle as a buffer to handle any claims that may happen. And ultimately, you want to have a smooth transition for your employees, right? So what is the right time to tell them? What is the right time that they are, that you're selling the company, and to give that reassurance, hopefully, that this is going to be a smooth process. You vetted out the new owners, reassure them, because this is their livelihood and their family's livelihoods on the line. And honestly, they need to stay on with the company in order for its future to be successful. So when is the right time to tell them? How will you inform them? Working with the buyer is critical to ensure that you get a good messaging. They get to meet with them. All that stuff is planned out sometimes before the close. I have another client right now that is reached out because they're being proactive to find a new CEO for the company that they will be acquiring. Confidential to the outside world. However, they've been very open with the employees at the company. Both the buyer and the seller have talked with the employees. They've spent many visits with them. The employees are excited. They see the future. They see this as an opportunity for the company to bounce back from where it used to be thriving a couple decades ago. It's kind of languished. They see this as an infusion for them, and they're excited about the future. How will your employees react? So you want to get in front of that so you have the best message and best story that you can for them. So it's the smoothest possible scenario that you can have. My last example, I have one more, I can share one more. A deal that was very rocky, and it continues to linger on. It's been like 2 years after the sale. The owner didn't know what they didn't know. When you're talking about these documents, and his lawyer that was assisting him, he didn't read all the fine print that well. So after the sale was done, he made things very difficult because he just didn't understand. He thought he felt like he should have gotten a higher selling price, but the deal was done. So they're now entering into litigation to go through that. Complicate it further, he kept the buildings that and became essentially the new owner's landlord, and then sold a couple of those buildings. So now they have a new landlord. So all this complexity was involved. So I would say on that side, the buyer should be aware of all of those sticky points that you could still be entering into litigation well after the sale is done, but you're still tethered to that person. And it's costly when you're dealing with litigation. It's costly. So,
thanks, Elizabeth. So I think we've illustrated for this first 45 minutes that it's not a very short timeline. It's a long timeline when you plan on transitioning your business. And so let's say we've gone through, we're thinking about it, we're going through the due diligence, and all of a sudden there's a letter of intent on your desk. And so that is not the time when you have, I assume, Mike, you don't do tax planning or estate planning after the LOI is signed or the deal is signed. So what are some of the things that you might want to do before the LOI is signed from an estate planning standpoint? And I think Ryan will kind of follow up with, once we have maybe some cash in our back pocket, how do we do our financial planning? So thanks, Mike.
All right. The real question is who should be owning this? Like, do you fracture the ownership among family members, or do you not? And a lot of these things, it's extremely fact specific. What kind of entity are we dealing with? What's the basis in the entity? How old are the owners? That may play into it. And we have all of that needs to be addressed. But really, I guess the starting point is what are the goals or intentions of the owners? What do they want to happen with either the company, or if if it's not an inside family succession, if they're selling to the outside, what do they want to have happen with those proceeds? Do they want them to go outright in their estate plan to their family members, or do they want them some governance over the assets in a trust? Do they have any donative intent? Is there any charitable bent to this thing where there could be some matching of that with during the deal, that some of it goes to charity to mitigate the income tax implications of the deal itself? And so you look at these things, generation skipping. A lot of these things are very fact specific. Am I in a situation where I have a taxable estate? Currently, it's $24 million for a married couple, $12 million each. Anything over that on the valuation is taxed at 40%. We can also work on structuring this to get the value lowered based on discounts and things like that. And also during the post-transaction, during the owner's lifetime, there's ways of doing gifting and structuring things where we can get more of the assets out of the taxable estate and onto family members during their lifetime. All of those things are considered. In the earlier you start, I tell people I'd rather give away the seed than the redwood. So if I'm giving away a little bit of equity, or they have something, and all of this depends on how much you have. How much are you comfortable giving up? And can you afford to give it up without worrying about that you have enough post-transaction? And that, as Eric said, it's not the selling price, it's the net. And we typically, we haven't talked too much about what happens during the deal, but when there's a letter of intent that Mike just mentioned, we typically take it apart and we go through a formula on a 30,000 feet. It's consideration, less basis, gain, calculate the tax. And then we schedule out when the cash comes in, when the taxes are due, and give a timeline to the client about when they can expect to receive the cash. Oftentimes, the consideration is complex in that there's more elements to the consideration, and the assets, it may be an asset sale, maybe a stock sale. We have to model that because the gain may be different. You get capital gain rates, you get recapture rates. We have multi-state, we may have international issues. We calculate all that tax, but we basically come to what's available, okay? Now, if you're selling this business and you're doing estate planning, and you did some estate planning 10 years before the sale, you may have already removed a lot of the value out of your estate by doing those transactions 10 years ago. You may have set it up in some kind of a trust that owned a part of it. And so that is not all the increase in the value and the gain will be out of your estate. So the sooner you do some of these things, the better. And it is there's a lot of value to looking at these things way in advance. Okay. Now, the other thing I just want to touch on briefly is we do a lot of deals. I got an email in the middle of this on a deal we're working on right now. Some of them are $100 million, $200, $300 million, and a lot of them are a lot less than that. This one's $10 million. But it is important that you get counsel that does these things on a regular basis. They handle their M&A attorneys, and they're not just the corporate attorney. Okay, they know these things because there's very specific legal issues throughout the agreement. Okay. And there's about, we can talk about a lot of these things for days. Every element of what was discussed here could be just elaborated on for days. But it's important that you really start to have a conversation with your counsel, and you start to get a framework, and you start to get knowledgeable about what the situation is in your company, what the rules are, what you can expect, what the process is like, so you can prepare it. When Elizabeth was talking about the data room and the due diligence, it's like buying a car. If the fit and finish isn't good, they're gonna think that the engine isn't any good. So when your financial statements are not really where they should be, and your records, you can't produce the information they're asking you for, that's not a good look. Okay, so those are the kind of things you kind of have to think about before you go through the process.
All right, thanks, Mike. So let's say we have our deal done, and Ryan, from your aspect, where do you and your team, where do you see how you help that person who's maybe transitioned out of his business or her business, and they want to make sure that their quality of life continues to continue? So how do you help your clients through that transition or post-transition?
Yeah, I mean, that's a great question. How do you keep and maintain your quality of life, right? If you're gonna choose to do this, most folks want to at least maintain their quality of life. And so good planning, thorough, comprehensive planning with the right team members should put you in a position to know what to expect and what's going to happen. But inevitably, there's so much focus on closing the deal that then you lift your head up and the deal is almost done, and then you're like, well, what now? And we see often the question that comes up, and usually it's very late in the game. It's the day before the close. It's 2 days before the close. It's the day of the close. And you're just trying to figure out, wait a second, where does the wire go? Where do I deposit this check? These are the little steps that are important, but in the grand scheme of closing the deal, you don't think about it. And so inevitably you'll say, okay, well, just wire it to the bank accounts we have established with whatever bank you use. Things to think about are, as soon as that wire comes in or you deposit that check, there are red flags up in most of these banks that are saying, okay, we got to contact you and talk about all the different banking services we have to help you with this proceed that just came in. So from a privacy standpoint, just be aware that you might all of a sudden find yourself being bombarded by third parties trying to talk to you about all the things you need to be doing. There are solutions to help you manage that privacy. So again, be mindful of that before you have to actually decide. Next are taxes, and we've talked a lot about this, but be really conservative with your tax estimate. It might be a year or more before you actually have to write the check and you know the number, but be prepared in case that number is a little higher than what you planned for. Give yourself a little buffer when you're allocating what to do with the proceeds. Give yourself a little extra in the taxes due bucket, and if taxes come in less, great. The last thing you want is all of a sudden you have a much larger tax bill due, and you're scrambling to figure out where to cover it from. So again, be conservative with what you budget for taxes. The next is, as you again, the proceeds come in, where's your income coming from to pay the bills next month at home? Okay, what about the next month and the next month? And so think ahead. So again, the timing is typically as soon as the deal is done, you start thinking about this, but a little planning goes a long way so you can maintain that quality of life, accomplish your financial goals, but think ahead and make sure even if you have to focus on closing the deal and working through those relationships, make sure your team has prepared you so that there's no gap in between this life and post-transaction, right? And then wait. Again, we typically recommend most of our clients, you have this massive life event. It's significant, it's great, it's important, celebrate. But before you allocate and commit any of the proceeds in a very significant way, make sure you take your time and take a step back, right? Be patient, get through the transaction, get through taxes, and as you're working through what you're going to do long term, but be patient. Again, you don't want to find yourself in a position where you overcommit the proceeds and all of a sudden you find yourself strapped for cash when there's no real reason for you to be. Again, planning helps with this. Additionally, in this year, you tend to find a big swing in taxable income. The year of the transaction, you might find yourself in a position where you have significant uptick in taxable income. And that there's a certain type of planning in that year post-transaction even, where there's some great tax planning opportunities. And then you might find yourself in the next year or 2 years later where your taxable income is significantly less. It might be close to nothing. So what are the tax planning and long-term financial planning opportunities that present themselves in those very unique years? So again, thinking ahead, focus on how are you going to pay your bills, as basic as that sounds, privacy, and planning cash flow over the next year or two beyond, to make sure that you're proactive as possible. And then the biggest one is enjoy it. What are you going to do to enjoy this moment? What are you going to do to pass the time now that you're not going to the business the same way you always did in most cases? What are you going to do for the next 10, 15, 20, 30 years of your life? And that's where a lot of fun planning comes in. But take that opportunity to congratulate yourself, celebrate this moment with you and your family and those other stakeholders. And again, good planning should provide you that opportunity to do that.
Thanks, Ryan. Really appreciate that. So bringing Jen back in, I think hopefully this has been a lot of valuable information, and this is not a short-term decision or a short-term planning. It's a long-term planning. And as you see with the individuals, the panelists here, a successful team around you. So you might have that one individual who might be coaching you through everything. I think you probably need a more dynamic team. And so at this point, Jen, I think maybe we open up to any questions or any comments from you and your team.
Yeah, we absolutely are open for questions in the chat. If you have questions, feel free to share them again in the chat feature. So we'll just pause here for a second and see if there are any questions. Know that we will send this recording out. In addition to the recording being sent out, I will provide contact information for Raymond and Mike. We can touch base on what contact information you want sent out, but rest assured that we'll provide the recording as well as contact information. So Mike, I'm not seeing any questions right now in the chat, and it looks like we're coming to the top of the hour. So why don't we go ahead and thank you, Mike, and our panelists.
Well, first, can we mark this?
Yeah.
We actually finished on time. So I mean that's a goal that Raymond's probably this team hasn't accomplished. So we finished on time. So we need to hang stars on our refrigerators at home.
Yeah, there you go.
I am confident there are things the panelists wanted to share, but they were very mindful of the time. So again, thank you, Mike, and your team and the panelists today. The insight that you've provided, it was extremely helpful for our manufacturers on the line. So thank you again. We look forward to the next engagement between MGA and Raymond so we can keep our manufacturers informed on relevant topics. So
Thanks, Jen, and thanks for this opportunity. Appreciate it.
Absolutely. Thank you all.